In 1930, the United States passed the Smoot-Hawley Tariff Act, raising import duties on over 20,000 goods to protect American industry from foreign competition. Within 2 years, global trade had collapsed by 66%. The tariffs didn't save American jobs. They triggered a chain reaction of retaliation that turned a recession into the Great Depression. What policymakers thought would protect their economy destroyed it instead. Today, in 2026, the United States has imposed tariffs on over $600 billion in Chinese goods, while simultaneously deploying artificial intelligence systems that are automating capital allocation, risk assessment, and trading decisions at a scale humans cannot match. Global trade growth has slowed to its weakest pace since 2009. Currency volatility has reached levels not seen outside of financial crises. Yet stock markets remain near all-time highs, disconnected from the trade collapse unfolding beneath them. How does an economy built on global supply chains and algorithmic capital flows respond when both the rules of trade and the nature of decision-making change simultaneously? For most of recorded history, trade operated under constraints that were physical, not political. Goods moved slowly, by ship, by caravan, by rail. Information moved even more slowly. A merchant in London might not learn for months that his shipment had been seized by pirates or lost in a storm. This friction created natural limits on how complex trade networks could become and how quickly they could adapt to disruption. Money in this world was tangible. Gold and silver coins crossed borders because they held intrinsic value regardless of whose face was stamped on them. A Spanish doubloon spent in Amsterdam had value not because Spain said so, but because it contained a measurable quantity of gold. This created a natural equilibrium in trade. Nations that imported more than they exported would see gold flow outward to settle the imbalance. This gold drainage would eventually force either a reduction in imports, an increase in exports, or a currency devaluation that made exports more competitive. The British Empire, at its height in the 19th century, operated the largest trade network in history under this system. British merchants traded textiles for Indian cotton, Chinese tea for South American silver, African resources for manufactured goods. The entire system balanced on gold-backed currency and the Royal Navy's ability to keep shipping lanes open. When trade imbalances occurred, they were resolved through gold flows, not through tariff walls or currency manipulation. This system was stable because it was self-correcting. A nation could not run persistent trade deficits without eventually running out of gold to pay for imports. It could not devalue its currency without losing gold reserves. It could not impose tariffs without risking retaliation that would harm its own exporters. The constraints were physical and mathematical, not political and negotiable. The collapse of this system began with World War I. Nations suspended gold convertibility to print money for war funding. Trade networks that had taken centuries to build were severed in months. After the war, attempts to restore the old system failed because the conditions that had supported it, political stability, fiscal discipline, and commitment to fixed exchange rates, no longer existed. The 1930s saw the consequences of trying to manage trade without the stabilizing mechanisms of the gold standard. When the United States imposed Smoot-Hawley tariffs in 1930, other nations retaliated immediately. Canada increased tariffs on U.S. goods by 30%. France, Britain, Germany, and Italy followed with their own protectionist measures. Global trade, which had been recovering from the post-World War I disruption, collapsed. The key insight is not that tariffs caused the Depression. The Depression had multiple causes. The key insight is that in an interconnected global economy, protectionism triggers cascading failures. Tariffs reduce imports. Reduced imports mean foreign nations earn fewer dollars. Fewer dollars mean they cannot buy American exports. Reduced exports mean American factories lay off workers. Unemployed workers buy less, deepening the domestic economic contraction. The cycle reinforces itself until trade collapses entirely and nations retreat into autarky. Economic self-sufficiency that is far less efficient than specialization in trade. China experienced a version of this in the 15th century. The Ming dynasty, under the Hongxi and Xuande emperors, pursued a policy of maritime isolation. The treasure fleet expeditions that had reached Africa and potentially beyond were terminated. Trade was restricted. China turned inward, convinced it could be self-sufficient. For a time, this worked. China was vast and resource-rich, but the policy also meant China missed the age of exploration, the scientific revolution, and the industrial revolution that transformed the West. By the 19th century, an inward-looking China was technologically inferior to European powers it once rivaled. The pattern across history is consistent. Open trade creates wealth, but also vulnerability. Closed trade creates security, but also stagnation. Nations oscillate between these poles based on whether they fear external threats more than internal inefficiency. And when major powers choose closure simultaneously, global economic activity contracts rapidly and unpredictably. The modern global trade system was not designed to be fair or equitable. It was designed to prevent another world war. After World War II, The architects of the Bretton Woods system understood that economic nationalism had contributed to the rise of fascism and the descent into global conflict. The solution was to create structures that made trade interdependence so deep that war between major powers would become economically suicidal. The United States, holding the majority of global gold reserves and the only major industrial base untouched by war, agreed to open its markets to allies' exports while maintaining the dollar's convertibility to gold. This created persistent U.S. trade deficits. The U.S. imported more than it exported. But those deficits served a strategic purpose. They flooded the world with dollars needed for reconstruction and trade. And they created economic ties that aligned with American geopolitical interests. The system worked for 2 decades. Europe and Japan rebuilt. Trade expanded. The dollar became the unquestioned global reserve currency. But by the late 1960s, the structural contradictions were becoming unsustainable. U.S. trade deficits meant dollars were accumulating overseas faster than America's gold reserves could back them. France began demanding gold for dollars. Other nations followed. The promise of convertibility was breaking down. In 1971, Nixon closed the gold window. The dollar was no longer convertible to gold. This severed the last physical constraint on currency creation and trade imbalances. A nation could now run persistent trade deficits without gold reserves draining. It could manipulate its currency value through central bank intervention without losing metal backing. Trade became a matter of political negotiation rather than mathematical settlement. The consequences took decades to materialize. The United States ran larger and larger trade deficits, exceeding $800 billion annually by the mid-2000s. China, in particular, became the primary surplus nation, accumulating trillions in dollar reserves by keeping its currency artificially cheap to make exports competitive. This created the imbalances that persist today. The U.S. consumes more than it produces, financing the gap through borrowing. China produces more than it consumes, financing U.S. consumption through lending. This arrangement was unstable but functional as long as both sides benefited. The U.S. got cheap manufactured goods that kept inflation low and living standards high despite wage stagnation. China got industrialization, employment, and technology transfer. The dollar's role as reserve currency allowed the U.S. to borrow at lower rates than economic fundamentals would otherwise permit. China's manufacturing export model created jobs for hundreds of millions, lifting them from rural poverty into urban middle class. But by the 2010s, the arrangement was fraying. The U.S. had lost significant manufacturing capacity. Factories closed, jobs disappeared, entire regions economically hollowed out. The political backlash was inevitable. China had accumulated over $3 trillion in foreign reserves and was developing technologies that threatened U.S. dominance in strategic sectors: artificial intelligence, quantum computing, biotechnology, advanced materials. The trade war that began in 2018 was not primarily about trade deficits. It was about technological competition and strategic decoupling. The U.S. imposed tariffs on Chinese goods not to balance trade, but to slow China's technological advancement and force supply chain diversification away from Chinese dependence. China retaliated not just with tariffs, but with restrictions on rare earth exports, technology transfer barriers, and development of alternative payment systems to reduce dollar dependence. By 2026, this conflict has evolved beyond tariffs into systemic fragmentation. The global economy is splitting into competing blocks with different technology standards, payment systems, and governance models. Companies must choose which markets to prioritize because operating in both simultaneously is becoming legally and technically difficult. Supply chains are being restructured at enormous cost, not for efficiency, but for security and political alignment. Meanwhile, artificial intelligence has introduced a new variable that amplifies these trends. AI systems now manage approximately 35% of all institutional capital allocation decisions. They execute trades in microseconds, identify correlations humans cannot see, and optimize portfolios across thousands of securities simultaneously. This creates efficiency, but it also creates fragility. When AI systems trained on historical data encounter conditions outside their training parameters, they produce results that can destabilize markets in minutes. The May 2010 flash crash was an early warning. Algorithmic trading systems triggered a feedback loop that caused the Dow Jones to fall nearly 1,000 points in minutes before recovering. Similar events have occurred repeatedly since. Sudden, unexplained volatility surges that human traders cannot prevent because they cannot react fast enough to algorithms operating at machine speed. AI is now being deployed not just in trading, but in credit allocation, risk assessment, and economic forecasting. Banks use AI to determine who gets loans. Governments use AI to assess economic health and guide policy. Central banks experiment with AI models to predict inflation and optimize monetary policy. This creates a system where decisions that once required human judgment and were constrained by human cognitive limits are now made by algorithms optimizing for narrow objective functions with no understanding of systemic consequences. The combination of trade fragmentation and AI-driven capital allocation is creating conditions fundamentally different from any previous period. Trade restrictions reduce efficiency and increase costs, but AI allows capital to flow around those restrictions at speeds that make traditional policy responses obsolete. Nations impose tariffs, but algorithms find workarounds through complex derivative structures and offshore arrangements. Governments attempt to control technology transfer, but AI systems are inherently replicable and difficult to contain. We are witnessing the simultaneous breakdown of post-World War II trade architecture and the emergence of machine intelligence that operates faster than human institutions can adapt. This is not a temporary disruption. This is a phased transition to a new system whose rules and equilibria are not yet established. The quantifiable impacts of trade fragmentation and AI integration are already visible in economic data, even as their full consequences remain uncertain. Global trade volume, which grew at an average annual rate of 7% from 1990 to 2008, has grown at less than 3% annually since 2012. In 2023, global trade growth was just 1.7%. In 2024, it was 2.1%. For 2025, estimates suggest growth of less than 2%. These are the weakest sustained trade growth rates outside of recession periods since World War II. Trade is not collapsing as it did in the 1930s, but it is stagnating in a way that suggests structural change rather than cyclical downturn. U.S.-China trade, which peaked at over $650 billion in 2018, has declined to approximately $575 billion in 2025, a reduction of over 11%. But the composition has changed even more dramatically. High-technology goods, which once accounted for 30% of bilateral trade, now represent less than 18%. The U.S. has restricted exports of advanced semiconductors, AI chips, and quantum computing components to China. China has restricted exports of rare earth elements, graphene, and certain battery technologies to the U.S. The cost of this restriction is measurable. The Semiconductor Industry Association estimates that export controls have reduced U.S. semiconductor industry revenue by approximately $15 to $20 billion annually. China's rare earth export restrictions have increased costs for U.S. manufacturers by an estimated $8 to $12 billion annually. These are deadweight losses, costs that benefit neither party but are accepted as necessary for strategic security. Supply chain restructuring costs are even larger. Companies moving manufacturing from China to Vietnam, Mexico, or back to the United States face costs ranging from 20 to 40% of annual production value for the transition period. Apple, for example, has announced plans to shift 25% of iPhone production out of China by 2027, a process estimated to cost between $8 to $10 billion. Similar restructuring is occurring across electronics, automotive, pharmaceutical, and industrial sectors. The artificial intelligence sector shows even more dramatic numbers. Global investment in AI technology exceeded $200 billion in 2023, up from $75 billion in 2020. By 2025, estimates suggest AI investment has surpassed $300 billion annually. This capital is flowing disproportionately into infrastructure, data centers, specialized chips, and energy systems to power them, rather than into applications that improve productivity in the real economy. AI's impact on financial markets is quantifiable through trading volumes and execution speeds. As of 2025, approximately 70% of equity trading volume in U.S. markets is executed by algorithmic systems. Average holding periods for stocks have fallen from 8 months in 1960 to 5.5 months in 2000 to less than 10 seconds for high-frequency trading strategies. The majority of market liquidity is now provided by algorithms that can withdraw instantly during stress, creating flash crash risks. Credit markets show similar patterns. AI-driven credit assessment now determines loan approvals for over 65% of consumer credit in the United States. These systems process applications in seconds that would have taken loan officers days. But they also deny credit based on correlations that may have no causal relationship to repayment probability. Studies have found AI credit models deny loans to qualified borrowers at rates 15 to 20% higher than human underwriters, particularly for borrowers with non-traditional credit histories. Currency markets are experiencing unprecedented volatility, measured by implied volatility indices, which track options pricing. The Deutsche Bank Currency Volatility Index, which averaged around 8 to 10 in the 2010s, has spiked repeatedly above 15 since 2022. The Chinese yuan, which was relatively stable against the dollar from 2008 to 2015, has fluctuated between 6.3 and 7.3 yuan per dollar since 2018, a range exceeding 15% that would have been considered crisis-level volatility in earlier periods. Foreign exchange reserves held by central banks show continuing diversification away from dollars, but at a pace that has accelerated. Dollar-denominated reserves fell from 71% of global total in 2000 to 59% in 2020 to approximately 58% in 2024. That appears modest, but in absolute terms it represents over $2 trillion in diversification. Gold reserves held by central banks have increased for 15 consecutive years through 2025, with total official holdings exceeding 36,500 metric tons. The energy costs of AI are becoming systemically significant. A single training run for a large language model consumes approximately 1,300 megawatt hours of electricity, equivalent to the annual consumption of 130 U.S. homes. Data centers supporting AI operations now consume over 2% of total U.S. electricity generation, up from 1% in 2018. Projections suggest this could reach 4 to 5% by 2030. This creates competition for energy resources and upward pressure on electricity prices that affects all sectors of the economy. Corporate debt levels remain elevated despite higher interest rates. Total U.S. corporate debt stands at approximately $11.5 trillion as of late 2025. Of this, roughly $4.5 trillion is rated BBB, the lowest investment grade rating. If a significant portion of BBB-rated debt is downgraded to junk status during economic stress, it would trigger forced selling by funds mandated to hold only investment-grade securities. This creates a potential cascade where downgrades trigger selling, selling depresses prices, price declines trigger more downgrades. Government debt trajectories remain unsustainable across major economies. U.S. federal debt exceeds $36 trillion. Japanese government debt exceeds 260% of GDP. Combined debt of G7 nations has surpassed $50 trillion. Interest costs are rising as debt issued at near zero rates matures and must be refinanced at 4 to 5%. This creates fiscal constraints that limit governments' ability to respond to trade disruption or financial stress through spending programs. The numbers reveal a system under multiple simultaneous pressures: trade stagnation reducing efficiency gains, AI deployment creating fragility through speed and complexity, currency volatility signaling declining confidence in coordinated monetary management, and debt burdens limiting policy flexibility. None of these alone would necessarily trigger crisis, but their interaction creates emergent risks that are difficult to model and impossible to predict with certainty. Markets send signals through price, volume, volatility, and correlation changes that appear before crises become obvious. What these signals are saying now is that the combination of trade fragmentation and AI-driven capital flows is creating conditions where traditional stabilization mechanisms may not function. The first signal is the persistent disconnect between equity markets and underlying economic fundamentals. The S&P 500 trades near all-time highs despite corporate revenue growth slowing to under 3% annually, the weakest, outside of recessions, since 2009. Earnings multiples have expanded to levels typically seen only at market peaks. This divergence suggests equity prices are being driven not by improving fundamentals, but by liquidity and algorithmic momentum strategies that prioritize price trends over valuations. AI trading algorithms optimize for recent price patterns. When prices rise, algorithms buy, which pushes prices higher, which triggers more algorithmic buying. This creates self-reinforcing rallies disconnected from corporate earnings or economic growth. The risk is that when the trend reverses, the same algorithmic strategies will amplify the decline. Human traders might average down or wait for fundamentals to improve. Algorithms simply execute their programmed strategies, which during downturns means selling into weakness. The second signal appears in commodity markets, particularly industrial metals that reflect real economic activity. Copper, often called Dr. Copper, for its diagnostic value in assessing global growth, has traded in a narrow range despite significant swings in economic data. This suggests either that markets are uncertain about future demand or that AI-driven inventory management has smoothed out the demand fluctuations that would normally move prices. Silver provides a more specific signal. Industrial silver demand has grown approximately 18% annually since 2020, driven primarily by solar panel production and electric vehicle electronics. Yet silver prices have not reflected this demand surge. They remain range-bound between $22 and $29 per ounce, well below the 2011 peak of $49. The explanation lies in the growing gap between paper silver trading and physical silver availability. COMEX registered silver inventories, silver available for immediate delivery, have fallen from over 350 million ounces in early 2020 to under 35 million ounces as of late 2025. This represents a 90% drawdown. Yet open interest in silver futures remains above 200,000 contracts, representing claims on over 1 billion ounces. The ratio of paper claims to physical availability has expanded to levels that would be unsustainable if even a small percentage of contract holders demanded delivery. This disconnect exists because most futures trading is conducted by algorithms that never intend to take delivery. They trade purely on price momentum and correlations with other assets. Physical silver users, solar manufacturers, electronics companies obtain metal through long-term supply contracts, not through futures markets. The two markets operate in parallel with limited interaction until physical shortages become severe enough that industrial users cannot secure supply through normal channels and turn to spot and futures markets for emergency procurement. Currency markets are signaling stress through correlation breakdowns. Traditionally, strong U.S. economic data would strengthen the dollar as it suggests higher interest rates and better returns. But since 2023, this correlation has been inconsistent. Strong U.S. data sometimes weakens the dollar as markets interpret it as increasing trade deficits or accelerating de-dollarization. This suggests currency markets are pricing geopolitical risk and structural shifts rather than just economic fundamentals. The Chinese yuan's behavior is particularly noteworthy. Despite trade surpluses that should theoretically strengthen the currency, the yuan has been under persistent depreciation pressure. This reflects capital outflows as Chinese investors seek to diversify holdings overseas, concerned about domestic economic slowdown and policy uncertainty. The People's Bank of China has intervened repeatedly to prevent sharp devaluation, but these interventions deplete reserves and cannot be sustained indefinitely if capital outflows continue. Credit markets show stress through widening credit default swap spreads and declining leverage loan covenant quality. CDS spreads on investment-grade corporate debt have widened by approximately 30 to 40 basis points since early 2024. Not crisis levels, but elevated. More concerning is that spreads have widened despite equity markets being near highs. This divergence suggests bond markets are pricing risks that equity markets are ignoring. Covenant-light loans, loans with minimal lender protections, now represent over 80% of leveraged loan issuance, up from approximately 25% in 2010. This means that when borrowers face stress, lenders have limited ability to force restructuring or operational changes before defaults occur. The shift toward weaker covenants occurred during the zero-rate era when investors reached for yield by accepting higher risk. Now, as rates have risen and many of these borrowers face refinancing at much higher costs, the lack of covenants means lenders cannot intervene until it's too late. Treasury markets provide another signal through auction dynamics and liquidity measures. Bid-to-cover ratios at Treasury auctions have declined modestly but persistently. More significantly, the bid-ask spreads on off-the-run Treasuries, older issues that are not actively traded, have widened substantially. This indicates declining market-making activity and reduced liquidity. In stress scenarios, this could mean that even Treasury securities cannot be sold quickly without significant price impact. AI systems monitoring these markets are sending their own signals through behavior changes. Volatility targeting algorithms, which adjust exposure based on recent price fluctuations, have been reducing equity positions as volatility has risen. This creates a feedback loop. Algorithms reduce exposure, which reduces liquidity, which increases volatility, which triggers further exposure reduction. During the COVID crash in March 2020, estimates suggest volatility targeting strategies amplified the decline by approximately 30% beyond what fundamentals alone would have caused. The emergence of AI-driven market signals that are invisible to human analysis creates a new category of systemic risk. Humans can interview companies, assess management quality, evaluate competitive dynamics. AI systems optimize on data patterns that may have no fundamental basis. When markets are driven increasingly by algorithmic strategies that humans do not fully understand, the risk of unpredictable instability increases. The combination of these signals, equity fundamental disconnect, commodity market uncertainty, physical paper market divergence, currency correlation breakdowns, credit market stress, declining treasury liquidity, and opaque AI-driven flows, paints a picture of a system that is functioning but fragile, not in crisis, but operating closer to the edge of stability than at any point since 2008. And unlike 2008, where the problem was primarily in mortgage securities and bank balance sheets, the current fragility is distributed across trade structures, currency systems, and algorithmic market infrastructure. This makes it harder to diagnose and potentially harder to contain if stress escalates into crisis. History provides limited guidance on what happens when global trade fragmentation coincides with algorithmic capital allocation, because this combination has never existed before. But history does provide patterns for how trade wars end, how technology disruptions resolve, and how financial systems respond when complexity exceeds human capacity to manage it. Trade wars historically end in one of three ways: negotiated resolution, where both parties compromise; victory, where one side capitulates due to economic pain; or escalation into actual military conflict. The US-China trade conflict does not fit neatly into any of these categories. Neither side is likely to capitulate. Both have domestic political constraints that make backing down costly. Negotiated resolution is difficult because the conflict is not primarily about trade balances, but about technological supremacy and strategic competition. And while direct military conflict remains unlikely, proxy conflicts and regional tensions related to the broader competition are already visible. The most probable outcome is persistent fragmentation, a world where trade continues, but through increasingly separate and incompatible systems. Companies will be forced to maintain parallel supply chains, one for Western markets, one for China-aligned markets. Technology standards will diverge, creating inefficiencies and duplicated effort. Financial systems will bifurcate, with dollar-based and WAN-based payment networks operating largely independently. This fragmentation has costs that compound over time. The World Trade Organization estimates that complete trade decoupling between major blocs could reduce global GDP by 5 to 7% over a decade, a loss of approximately $5 to $7 trillion in economic activity. But the loss would not be distributed evenly. Highly globalized sectors like semiconductors, pharmaceuticals, and advanced manufacturing would suffer disproportionately. Countries dependent on exports to both blocs would face impossible choices. The impact on inflation is uncertain but likely negative. Globalization from the 1990s through 2010s kept consumer prices low by allowing production to shift to lowest cost locations. Fragmentation reverses this. Companies must produce in higher cost locations to satisfy political requirements or security concerns. These costs will be passed to consumers as higher prices or absorbed as lower corporate profits. Either outcome is economically contractionary. AI's impact on employment follows patterns seen in previous technological disruptions, but potentially faster and more comprehensively. The Industrial Revolution displaced agricultural workers over decades, giving time for retraining and adjustment. AI is displacing knowledge workers, accountants, analysts, radiologists, customer service representatives, at speeds that leave little time for labor market adjustment. Estimates suggest AI could automate 25 to 40% of current jobs within 10 to 15 years, concentrated in sectors previously considered safe from automation. The social consequence of rapid labor market displacement is political instability. When large populations lose employment and see no pathway to equivalent replacement work, they support radical political movements, promising restoration or revolution. This pattern played out during the Industrial Revolution with Luddite movements and labor unrest. It played out during the Great Depression with the rise of fascism and communism. The modern equivalent would be populist movements that reject both trade openness and technological advancement, demanding protection through autarky and restriction. Financial market consequences of AI dominance are potentially more immediate. When the majority of capital is allocated by algorithms optimizing for narrow objectives, markets become prone to cascading failures that cannot be stopped by human intervention. The 2010 flash crash demonstrated this at small scale. $1 trillion in market value vanished in minutes. As AI becomes more dominant and strategies more complex, the potential for larger, more persistent dislocations increases. The specific risk is correlation cascade. AI systems are trained on historical data that includes correlations between assets. When stocks fall, bonds typically rise. When oil rises, currencies of oil exporting nations typically strengthen. But these correlations are not laws of nature. They are behavioral patterns that can break. If AI systems encounter conditions where historical correlations fail, they will produce unpredictable results. In 2020, when COVID lockdowns began, correlations broke down. Stocks fell, but so did bonds, a scenario that should have been impossible according to historical patterns. Gold fell despite safe haven demand. Oil went negative. AI systems trained on historical patterns had no framework for this environment and either shut down or executed strategies that amplified volatility. Human intervention by central banks with unlimited liquidity prevented catastrophe. But the episode demonstrated that AI-driven markets can enter states where they amplify rather than dampen shocks. Currency consequences of persistent trade conflict could be severe. The dollar's reserve currency status depends on dollar liquidity in global markets and confidence in U.S. economic management. Trade fragmentation reduces dollar liquidity as bilateral trade shifts to alternative currencies or barter arrangements. AI-driven capital flows move money so quickly that traditional mechanisms for managing exchange rates, central bank interventions, interest rate adjustments, become ineffective. If the dollar were to lose reserve status, not completely but significantly, the consequences for the United States would be substantial. Currently, the U.S. can borrow at lower rates than fundamentals justify because of global dollar demand. Loss of reserve status would increase borrowing costs, potentially by 100 to 200 basis points, adding hundreds of billions in annual interest expenses to federal budgets. It would also reduce the effectiveness of financial sanctions, which work because dollar transactions must clear through U.S. banking systems. The debt dynamics discussed in previous analyses become even more stressed under these conditions. If trade conflict reduces growth, AI displacement increases unemployment. And currency status deterioration raises borrowing costs. The fiscal position becomes unsustainable faster than current projections suggest. This could force difficult choices: austerity during economic weakness or monetary financing that risks currency credibility within years rather than decades. The historical lesson from similar periods of technological and geopolitical disruption is that systems under multiple simultaneous stresses do not typically adjust smoothly. The interwar period saw technological advancement, trade conflict, currency instability, and political radicalization occurring simultaneously. The result was not gradual adaptation, but catastrophic breakdown culminating in World War II. While direct parallels are imperfect, the pattern of multiple mutually reinforcing stresses overwhelming institutional capacity to manage them is disturbingly similar. What makes current conditions potentially more dangerous is speed. In the 1930s, trade collapsed over years. Financial crises played out over months. Today, algorithmic trading can destabilize markets in minutes. AI-driven capital flows can drain emerging market currencies in hours. The timeframes for human policy response have not shortened correspondingly. Central bankers and government officials still operate on meeting schedules, deliberation processes, and implementation lags measured in weeks or months. This mismatch between machine speed and human response time creates vulnerability to rapid cascading failures. The final historical lesson is that complexity itself becomes a source of fragility. Simple systems with clear cause and effect relationships are resilient because problems can be diagnosed and addressed. Complex systems with opaque interactions and emergent behaviors are fragile because small disruptions can cascade in unpredictable ways. The global financial system has become extraordinarily complex through the combination of trade interdependence, financial instrument proliferation, and algorithmic management. This complexity may appear as sophistication and efficiency during normal times, but during stress, it becomes a transmission mechanism for crisis. In 1930, protectionist trade policy seemed like a reasonable response to economic distress. Each nation acted to defend its own interests, none intended to trigger a global depression. But the interconnected nature of trade meant that what appeared rational at the national level was catastrophic at the system level. The Smoot-Hawley tariffs and the retaliatory measures that followed reduced global trade by 2/3 and deepened the economic collapse that made World War II possible. Today, trade restrictions are being imposed not from simple protectionism, but from strategic necessity, as great powers compete for technological dominance. The consequences may be different, but the logic is similar. What appears necessary for national security creates global economic fragmentation that reduces overall prosperity and increases systemic fragility. Artificial intelligence adds a new dimension to this fragility. Markets that once reflected human assessment of value and risk now reflect algorithmic optimization of mathematical functions. Capital flows that once moved at the speed of human decision-making now move at machine speed. This creates efficiency during stability, but amplifies instability during stress. And the stress is already visible in trade volumes that have stagnated, in currency volatility that has surged, in physical paper market disconnects that have widened to unprecedented levels. The question is not whether these conditions will cause a crisis. The question is whether human institutions can adapt their governance structures, policy tools, and response mechanisms fast enough to manage systems that now operate at speeds and complexities beyond unaided human cognition. History suggests the adaptation will lag the disruption. Technology advances faster than regulation. Markets evolve faster than policy. Human nature, political tribalism, institutional inertia, short-term thinking remains constant even as the systems we build become exponentially more complex. What AI and trade wars are doing to global finance in 2026 is not creating an immediate crisis. They are creating conditions where the next shock, whatever it is, will propagate faster across more interconnected systems, with less time for human intervention than any previous disruption in history. The machinery we have built to manage capital and trade now operates faster than we can control it. And the political decisions we are making to fragment that system for strategic reasons are removing the redundancies and buffers that previously prevented local failures from becoming systemic collapses. This is not prediction. This is observation. The trajectory is established. The mathematics are visible. The historical patterns are clear. What remains uncertain is timing, but trajectory over sufficient time determines destination regardless of timing uncertainty. And the destination, if current patterns persist, is not adaptation. It is disruption.